All right, so today's video, what are the Greeks? We're going to break down what they are, what they mean, and how it affects our options trading. Right, so getting right into it, we're going to start off with the big boy delta. Delta is a risk metric that estimates the change in the price of a derivative, such as an options contract, given a $1 change in its underlying security. We've talked about it before, how owning an options contract is the right to own 100 shares, but not the obligation. Um, so every $1 move on its underlying asset should be around equal to $100. It's not always a 1-to-1, um, but typically that's in theory how it works. So, example: if a SPY call contract has a delta of $31 and the price is 110, and SPY moves $1 upward, then the price would be $141 in theory, right? So again, since it's a call and it's $31 a delta per dollar that it moves. If it moves up a dollar, the price of the contract will move from 110 to 141, right? And if it were to move downwards on a call, then you would lose $31 per dollar that SPY loses. So yeah, it's pretty important. If you want to look more into it, I definitely recommend YouTube videos, Google, etc. Because Delta is probably the one that you want to pay the most attention to, right? Obviously, the other ones are super important, but Delta is probably the one you'll use the most. And Theta, of course. This one, Theta, is another big boy. It measures the rate of change in an options premium in relation to the passage of time, typically 1 day. Um, where same days, if it's a same day contract that expires out of the money, it will always be worthless at the end of the day, and the Theta will always be more than the contract because it's not a 24-hour time period that it expires. It expires within that trading day. Um, but yeah, that's why contracts super far out in time, right? If we were to talk about buying a contract in July right now, the Theta wouldn't be that big because there's tons of time on that contract. But yeah, anyway, if that same SPY contract that we just talked about, that's priced at $110, has a Theta of minus $50, by the next day, the next 24 hours, if the price of SPY were to stay the exact same, the contract would be worth 60. Again, if it were to stay the exact same, it won't. It will move up and down, but it'll still lose $50. Um, so again, for weekly contracts or next day contracts, even the Theta will kill it, and it will kill it pretty fast every single day, right? That's why you have to be careful if you're swinging a SPY contract from Thursday to Friday. Look at that Theta and look how much you're going to lose overnight in that single day because it expires the next day. Again, contracts super far out in date. They won't have a high Theta and it won't kill you that much. That's why you swing them. Um, but yeah, same days, and especially contracts that expire weekly or again same day will die extremely fast because of Theta, right? And again, if you have a SPY contract that's the same day that's worth $28 and expires in 3 hours, the Theta will be higher than $28 because by the time the day ends, it'll be worthless, right? Um, Contracts that are in the money will have smaller Thetas than contracts that are out of the money, etc. So let's see. Gamma. Gamma represents the rate of change between an option's delta and the underlying asset's price. Contracts deep in the money or deep out of the money will not have a huge change in delta if the underlying price moves, but contracts at the money will. So again, I'll give you an example of this, right? Let's say SPY is at 510 and we want to take a 520 call, right? The call is worth only $1. It's a same day contract. It's only worth $1, right? Even if SPY moves to 515, that contract might only be worth $2 now. Sure, it's 100%, but the delta was only at less than $1 basically, right? But as you get closer to the money, that delta will start to go up and increase, right? So I'll give you an example of today with Bonsai's trade, the 509 or the 508 put, I think it was, when SPY was at 509. At first, your contract for every dollar that it's moving for the delta is only making, 20, 30, $40, right? But if it's an $80 contract, that's 50%, right? But when SPY went to 502 or 503 or whatever, that delta has now become, for every dollar that it moves, like $1.50, which is like 200% of your initial contract. But again, contracts that are super in the money. So let's say once it hits 502, if it's a delta of 150, if it moves down to 501, your delta might only be, $1.60. $1.70, right? $170. Or if it moves up a dollar from the 502, same thing. Might be $140, $130, right? Delta is not changing that much because you're deep in the money. Same with deep out of the money. Again, you have a 520 call and SPY's at 510. Contract's only worth like a dollar. Delta's probably less than a dollar. It gets to 515. Okay, then Delta becomes $2. But as you get closer and closer to the 520, now your Delta is going to be $30, $50, $100, right? That's why same days it's so risky to buy super far out of the money. Yeah, so that pretty much explains Gamma. We do have a Gamma King in the chat, in the Discord chat. His name's Blitzed. You could probably ask him a question about it. He's definitely taught me a thing or two about it. But yeah, on to the next one. So we got Vega. Vega measures the rate of change in an option's price for a 1% change in implied volatility. Good example of this is during earnings. When implied volatility increases, so does the price of the contracts, right? We've been talking about this in the chat. You can take AMD as a perfect example. Typical weekly contract on AMD, one strike out of the money might be $100, $200, $300, right? But today we saw it as $500, $600, $700, even $800, right? For just one strike out or in the money. So yeah, as implied volatility increases, so does the price of the contracts. And as it decreases, so do the price of the contracts. That's why earnings can be so deadly, right? Earnings overnight, the IV will be crushed and will come down a bunch, which is why the contracts will lose a ton of value. It really needs to stay in the money or move super in the money. And implied volatility is literally exactly how it sounds like. Since it's earnings, it is implied that it'll be volatile overnight, which is why the IV increases. Yeah. And once earnings are over, then implied volatility is no longer there because it's not thought to be volatile anymore, right? Which is what brings it down. So Vega just represents the change in option price relative to the implied volatility percentage. Yeah, if that makes sense. All right, so last thing I'm going to show you is real life examples of Greeks on Robinhood. So this is what they look like down here. You'll see Delta, Gamma, Theta, Vega, and Rho. And I didn't talk about Rho because it's just it's based on interest rates. For every 1% interest rates moves, how it'll affect the options price. Anyway, Delta is just as we said. It's so let's say you have a SPY contract that's worth $1. For every dollar it moves, you'll make $20 in your direction at least. And if it goes the opposite direction, you'll lose $20 per dollar that SPY moves. Yeah. Go over Theta as well. Every 24 hours, it will lose $20. That's why it's represented by a negative, because Theta will never bring your contract up, only down. It's why contracts that are dated for far out, if let's say we had a contract in July, the Theta will be much lower than something that say expires the next day or in a week, right? Contracts that are also super in the money won't be affected as much by Theta as one that's out of the money, because the ones out of the money will expire worthless, whereas the ones in the money will not. Which is why people with big money typically spend more, so that Theta and time decay will not hurt them as much. So yeah, Gamma is the representation again of how much an underlying asset moves, how much it will affect the price of the delta, right? Vega, again, is how much the price of a contract will move relative to implied volatility, which is this number here, 43%, right? So every percent that this moves, the contract will move $7 as long as it stays the same, right? Pretty much. It's why you had something like CGC today. Yeah. I bought puts, and even though the contract went up a dollar, CGC went up a dollar, right? I bought puts. Yeah. The price of the contract pretty much stayed the exact same because the implied volatility was so high and continued to rise, just simply based on the news today. So yeah, anyway, that's a breakdown of the Greeks. If you guys learned something, I hope you learned something. Anyway, stay safe, trade safe, and have a good night.